There is no cash. Cash is not going to be here. It means revenue and account receivable. It means customer just have our services but didn't pay us. He will pay us later. So we create customer account, which is account receivable, right? Understand? Second, revenue increase by 3,000. Yes. Account receivable increase. Yes. Debit credit. Revenue increase mean account receivable increase mean debit. And how you pronounce the entry? Lota?
Sorry, the entry?
Mm-hmm.
I'm not sure.
From debit to credit entry. Pronounce it. Lota.
Yes, I'm not sure.
Just participate. The pronunciation should be debit to credit. So which one is debit? Lota.
Yes, I'm still thinking. I'm not sure.
I just write it down here.
Credit, debit.
Can you see slide here?
Yes, but yeah, I'm not sure. Could someone else?
So account receivable is debited, right?
Yes, and the revenue is credit.
First you say account receivable, and now the next one is credit, which is revenue. So and then here revenue. So account receivable to revenue. Lota, understand?
Yes.
Account
Yes,
receivable to revenue.
debit.
So perform services, revenue increase, credit. On account, accounts receivable increase, debited. So you can just pronounce the entry account receivable to revenue. Right, Lota?
Yes.
Okay. So we know that account receivable, we don't have any previous account, so we open a T account. Debited through fifth transaction. So you write it down here. Service revenue, we already have the account. This is coming from fourth transaction, 7,000 now. From fifth, it is 3,000. We just posting, right? Took these numbers and put it here in T accounts. And now paid cash expenses, rent, salary, utilities. This is a little bit tricky, right? Up till now, what we have discussed, at least two account is going to be hit.
Account payable for a salary employee.
Account payable?
Yeah. No, receivable, sorry, I always mistake. Account receivable.
Florian, read this sixth transaction here. Paid cash expenses.
So there are three expenses in total, three minus in total.
Well done, Fabian, well done. So we have three expenses: rent, salaries, utilities. So these salary is already paid. It's not payable. We have already paid. Not we have to pay in future, right? We already paid. So this become our expense. So you have two options to make entry. Either you have three entry or either you make a joint entry. Okay, let's talk about this. So if you make a, single entry, so it would be, for example, rent 1,100 and employee salary 1,200. And utilities 400. And these are backed by cash. You paid cash, right? So entry would be, if you make a separate entry, you make a rent. Okay, you pay cash. Which two accounts are going to hit? Cash, decrease, mean credit. Rent expense, rent basically expense, right? Expense is increasing, which means debit, right? Entry would be debit to credit, which means expense to cash. So you write it down, expense to cash, 1100, and you write it down here in explanation that it is rent paid. Second would be salary. So similarly, cash is decreasing. So entry would be expense to cash, 1200 to 1200, and you write it down here, salaries paid. The third entry would be utility expense. Same concept here, cash decrease. So here expense, expense. This is the third one. This is the second one. This is the first one. Expense to cash, 400, and that is utility paid. Right? This is how you record separately 3 entry, and you can also make a 1 entry. So what is common here? Cash, right? And cash is credited here. So you make a single entry as well. How? Let's talk about this. So you write it down here, expense. Okay, expense. Which kind of expense? This is rent, utility, salary. So the small businesses, they make one account for all kind of expenses, but big companies, they segregate the expenses. They want to know that how much is their rent expense, how much is their utility expense, how much is their salary expense. They are huge, so they just make separate account for salary, separate account for utility, separate account for rent. Okay, so these all are debited. So what was the common? Common was cash. So you write it down here, 1100, 400, 1200, and that would be 2700. So you see, debit must be equal to credit. So you just add it down all, 11 plus 4 plus 1200. So answer would be, so you make a joint entry as well. You make separate entries as well, right? So go back to our slide here so that we further understand what's going on here. So you see here, cash paid, cash decrease. Decrease mean credit. Rent is an expense, rent expense increase. This is expense, right? Expense increase, debit. Employees' salaries expense increase, debit. Utility expense increase, debit. So rent expense, salary expense, utility expense to cash. So you see here, all the debits are written in alignment here, right? And then you have a space here, and the cash 2700. So everybody understand that? Kathleen, Lota, Fabian,
Yes.
Anis,
So the answer is in the question. First, we read the question: is it a debit? Is it an expense or we earn? And from this information, then we can decide.
You need to follow three-step process we just discussed in our earlier slides. That first you find out the account titles like accounts, and then you find out increase or decrease, and then write it down debit or credit, and then you pronounce the entry. Entry would be from debit to credit,
Okay.
right? This is how you make it. Understand?
Got it.
And if you want to post it, so you post it into T account. We already have cash account, so we don't need to make a new T account. We just post it. So what does it mean, this 214? It means this 50,000 is coming from first transaction, or if date is mentioned, you write down the date. So this 7,000 is coming from fourth transaction, 40,000 coming from second transaction, and now sixth transaction we have 2,700 on our credit side. So see, remember that I'm just making you understand that the right hand side is credit, left hand side is debit, right? But if you see here, nothing is written like credit here, debit here, right? Because now you obviously it's obvious that in T accounts this right hand side is credit, left hand side is debited. So it's obvious. If you write it down, okay. If you don't write it down, so it is basically obvious that there is a credit here, there is a debit here. Okay, so you see here the book didn't mention debit here or credit here, right? Because it's automatic, it is obvious. So if you all understand that, make this entry. Paid 1,900 on account payable created in transaction 3.
So the cash increase. You say account payable? Sorry, is the cash decrease because we got to pay someone.
Right. So right step process. Which accounts are going to hit? So you see paid 1,900 on account payable. So we have account payable, okay.
And we have cash. We remove the cash, right?
Well done, because you paid. So now accounts payable decrease or increase?
Increase. Account payable increase.
Florian, be very careful. Paid 1,900 on the account payable created in transaction 3. So in transaction 3, what happened? In transaction 3, we purchase supplies 3,700. So we increase our accounts payable with 3,700. And now in 6,